Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge and Your Tax-Free Life podcast. This is episode number 62. And last week, as I communicated to all of you, we started a four-part series on the fatal four. These are the major issues and concerns that most Americans are going to have to deal with in retirement. And that is the risk of living too long, which is the one that we covered last week. The risk of living with a disability, which we will be covering today. And then next week, we're going to be covering the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, and a number of other issues that are very critical to all of us in retirement. And then the week after that, we will do the risk of dying too soon. So obviously, I hope that you're enjoying all of these. I have been receiving, and we have been receiving, a number of accolades from some of you that were really very concerned about the risk of living too long that we covered last week, because there were a number of issues that we discussed last week that the vast majority of Americans do not take into consideration as they prepare for retirement. So with that being said, obviously, hopefully you'll enjoy our podcast today, because we're going to be dealing with a very critical issue, which is the risk of living with a disability. Now, I think it's important to understand that, before you try to figure out a solution to any problem, you have to understand what the problem is. And the more and the better understanding that you have of what the issues and concerns and the problems will be in retirement, then obviously the better the aptitude to try to find a solution. So when it comes to the risk of living with a disability, please bear in mind that it goes hand in hand with what we talked about last week. Last week we spent quite a bit of time discussing the risk of living too long. And the fact that living a long life is a good thing, well, many a times it is not, because there's a very high propensity to have needs for long-term care the longer that you live in retirement. And I believe that last week we talked about the three stages of retirement, what I consider to be the three stages of retirement. Phase one would be one of the better ones, because those are the go-go years, 65 to 75 in the traditional retirement world. Those are the years that you can do just about everything because you're still healthy and you want to catch up with life because you have spent a lifetime working and putting money aside in order to retire comfortably. So now you want to catch up with the things that you have been wanting to do for many, many years and you have not been able to accomplish. Now, once you get into your mid-70s, 75 to 85, is what I call the slow-go years. You're not as healthy as you were before. You may want to stay a little bit closer to home. Now, some of you may still want to do a little bit of traveling, but you may not travel as far as you did during the go-go years, and you want to stay closer to home and maybe spend more time with your family, your children, your grandchildren, and so forth. And then, once you get to the mid-80s, then that's what I consider the no-go years. Obviously, healthcare issues are going to take over for many of us. The issue with long-term care is going to become more of an issue now than ever before. So those are things that you need to prepare for. But at the end of the day, you have to factor in 3 decades in retirement. And that last decade could be a very, very important and crucial one for all of us that are listening to this podcast today. Now, in order for you to qualify for any type of long-term care benefit, and we'll talk about some of those in the next few minutes, there's something called the activities of daily living, activities of daily living. Short would be ADLs. And there are 6 activities of daily living: bathing, dressing, toileting, transferring, continence, and eating. Those are the basic ones. Continence pretty much means keeping it all inside, bowel movements and stuff like that. So those are the main activities of daily living. Now, in addition to that, you have something called instrumental activities of daily living, which are the IADLs, and those include, having the ability or the inability to do housework, managing money, taking medication, shopping for groceries and clothing, cleaning, telephone usage, emergency response, and so forth. Now, most insurance companies or most insurance policies that are sold in the marketplace will require someone to be unable, and let me rephrase that, they must be unable to perform at least 2 of the activities of daily living. If they're not able to perform at least 2 of the activities of daily living, then they may be prescribed some type of long-term care benefit, or they could activate a long-term care policy and/or any other type of benefit as long as is suitable within the contract that they may own. Now, one of the major issues that we need to pay attention to is that long-term care, it's very, very expensive. For instance, in 2016, in the state of Florida, which is a state that I live in, a long-term care and nursing home would cost somewhere around $91,250 per year. That's very, very expensive. So that means if you have assets set aside for retirement, the vast majority of the clients that I engage for the first time have really never taken into consideration the risk of living with a disability, because otherwise that would be a conversation that would get them to work a lot longer. Now, most Americans want to retire at 65. I'm totally against that because, retirement age is a number. And the longer that you work, the longer you're going to live, because obviously an active mind is something that is very important, for all of us as we get older in life. The other thing is that, you're starting to see more and more people working until the age of 70. Some people work into their mid-70s, and some people just never stop working. I'm one that I've been in my business for almost 30 years. So I love what I do. I have no intentions of retiring now. I may want to, cut down the number of hours that I work on a weekly basis. Instead of working 5 days a week, now I work 4. Maybe in the next few years, I want to cut it down to 3 days a week. But I want to make certain that in my personal life, I want to stay as active as I possibly can and as productive as I can possibly can for as long as I can afford. Now, fast forward to the year 2037, which is, by the way, not too many years from now. That's 18 years from now, if you want to think about it. So, if you're in your late 50s or early 60s, you may be experiencing a long-term care need at some point in time in the future, in the next 15 to 20 years. By the year 2037, it's forecasted that a nursing home in the state of Florida is going to cost north of $278,000 a year. Obviously, because the rate of inflation and the increase in cost in nursing homes and nursing facility every single year is actually 3 times the rate of inflation. So when it comes to long-term care, you cannot factor just a 3% inflation rate in order to mitigate those expenses, because you're going to fall short of your goals and objectives. Now, obviously, it's also important to realize that Medicare, and this is something that most of the clients that I engage for the first time did not understand, or, had this false sense of security thinking that Medicare was going to cover long-term care. Medicare does not cover the largest parts of long-term care. So you have to be very careful that if you have susceptibility to a long-term care need because of parents or grandparents and so forth, I think it's very important that you prepare accordingly, because Medicare is not going to be able to cover long-term care when it comes to your retirement planning. Now, obviously, Medicaid is another way to go, but Medicaid is something that, it has income, assets, age, citizenship, and state residency requirements and restrictions that many a times is very, very challenging for the vast majority of Americans to be able to qualify for. You pretty much, have to be an indigent, someone that has no assets and no money in order for you to be able to qualify for Medicaid services, depending on the state that you live in. Now, when we talk about long-term care insurance, because now the question is, okay, if we understand the problem, the longer I live, the more susceptibility I will be and my family will be in having to deal with long-term care issues. The other thing that a long-term care illness brings to the family unit is that, the big question of who's going to provide the care. How much is a person that is going to provide the care going to be paid? Is it going to be a family member? Is it going to be your spouse? In most cases, it is your spouse, and there are different levels of long-term care. Perhaps, early on, you can have home health care. And then you may have no choice but to go into some kind of a facility that will take care of you on a regular basis, but you're still, mobile in some ways, shapes, or forms. But then there may be a time where you have to go into a nursing facility, a nursing home. So there are different stages, and every individual will get into each and every one of those stages, and not necessarily in the same orders. Some people may just go from point A to point D. Some may go to point B or C. So it really depends on the type of illness and the type of sickness that you may have to deal with, and the services that can be provided at home in order to mitigate those issues. So obviously there are a number of long-term care insurance contracts or way to mitigate the risk. And these are the different chassis that as I call it, that would be able to provide certain long-term care benefits to you and to your family. You have the standalone chassis. You also have reverse mortgages. You have a hybrid annuity chassis, which is one that is being used quite often now in the United States. You have a life insurance chassis, which is being used quite a bit as well. You have also the charitable remainder trust. You may have Medicaid disability trusts. And obviously that would be a only trust exempt from Medicaid eligibility rules and so forth. So there are a lot of different ways in which you can try to mitigate that liability. Now, if we're talking about the standalone chassis, that would be, just buying a straight out long-term care policy. It exclusively protects long-term care risks. Premiums are most of the time payable for life. They could be paid for a specific period. Most companies will not guarantee premiums. That means that in the future, insurance companies reserve the right to increase your premium. And sometimes they'll increase the premium to a point that you may not be able to afford it based on your financial circumstances. There's a large opportunity cost if the contract is not activated prior to death. So let's say that you're 55 years old and you purchase a long-term care policy and you're paying $3,000-$4,000 a year for long-term care coverage. And 30 years down the line, you die peacefully in your sleep. There was an enormous opportunity cost because you actually paid a premium for an insurance company that you never activated, or an insurance policy that you never activated. So multiply 30 years times $4,000 in premium, that would be $120,000, plus an internal rate of return that you could have gotten on that premium, it could be well north of $200,000 that would have been the premium that you paid that you failed to benefit from, and or the opportunity cost on that premium. So the fact of the matter is that when you buy a long-term care policy, there could be a probability that you're never going to use the benefit. Now, less than 8% of clients own standalone long-term care policies. And the reason for that is twofold. Number one, many clients say prepare for retirement. They don't think that they're ever going to have a long-term care need. And although the statistics will say otherwise, they're making a bet. They're making a bet that they're going to live a long life, that they're going to die in their sleep without feeling any pain or any suffering, and that they're going to go to the next life along those lines. And also, the reason why only 8% own it is because it's costly. And most important is the fact that if they do die in their sleep, then obviously no one is going to collect on the benefit, and that would be a lost premium and opportunity cost along those lines. Now, another way to mitigate the risk of living with a disability and trying to protect yourself would be through reverse mortgages. A number of my clients have been able to do that. Lump sum, monthly, or line of credit payments that you can use to pay for your additional cost of long-term care. Title retention and ownership is something that you get with a reverse mortgage. Obviously, you're still responsible for taxes, hazard insurance, and repairs. You must be at least 62 years of age, but the older the better. So for you to qualify for a reverse mortgage, you have to be at least 62 years of age, but the longer you delay acting upon a reverse mortgage, the better it's going to be. There's no income or credit requirements. As long as funds are spent in the months received, the money is not taxable and has no impact on your Social Security benefits or Medicare premiums in retirement. Does not count as income for Medicaid benefits. So if you had to execute a reverse mortgage in order to mitigate the cost of long-term care or the increasing cost of long-term care, it does not count as income for Medicaid benefits, so you can still receive Medicaid benefits if you qualify for. Heirs could eventually refinance and keep the property upon the death of the property owner. Sometimes it makes sense, depending on market conditions and where the property is located, to just refinance, pay off the reverse mortgage company and maintain the property as a rental property. Many other times it makes sense to just sell the property and then pay off whatever is owed based on the reverse mortgage numbers, and then the families can retain the difference. Less than 3% of clients have executed a reverse mortgage. And I think, again, the reason for that is the fear of losing their home. Also the unknown. Lack of education could be another reason why not too many clients or not too many Americans have executed a reverse mortgage, although those numbers appear to be increasing every single year. Now, another way to mitigate that cost would be a hybrid annuity chassis. And I like those quite a bit because, number one, it offers flexibility. Number two, it gives you a velocity of money multiplier. So you do have dollar efficiency, meaning that you can purchase an annuity that will provide retirement income for yourself for as long as you live. You can have the money grow tax deferred. You can actually, depending on the type of annuity that you purchase, you can participate in the upswings of the stock market, but you don't participate in the downswings, so it means your principal is always protected. And most important, your dollars inside this annuity are providing a much better view of the world because you have velocity of money multiplier, meaning that $1 is performing more than one duty. So if you have this type of hybrid annuity chassis, that means that not only the dollar that you have in there is producing a retirement income for you for the rest of your life and potential growth, but it's also giving you the ability to protect against the risk of living with a disability, because at any point in time in which your health changes and now you qualify under the activities of daily living for benefits, many of these contracts will actually double the income that you were receiving in order to offset the additional cost of long-term care. Now, you need to have a long-term care rider inside that contract. Principal protection and creditor protection in Florida, which is a state that I live in, so that's very, very good that you have, the principal protection, that you cannot lose your principal. Obviously, it's got to be the claims paying ability of the insurance carrier, and that you do have credit protection in the state of Florida. It's quite important. You would have inside these hybrid annuity chassis income that you cannot outlive. Opportunity cost, that we discussed in the previous scenario, is greatly reduced. Someone will always receive a benefit. And approximately 40% of clients that I deal with own a hybrid annuity long-term care benefit feature contract. Now, some clients have a combination of both. They have the hybrid annuity. Also, a number of insurance companies have now come out with something that is called a life insurance chassis. Think of the annuity chassis, except that this one has a death benefit. Again, gives you flexibility, gives you a velocity of money multiplier. So that means that there's a long-term care rider inside a life insurance contract. And if you become disabled prior to your death, then the insurance company gives you the ability to start using the death benefit while you're alive in order to mitigate the cost of long-term care. So it gives you the best of both worlds. Someone is always going to get the benefit, because if you bought it at 55 and 30 years later you die in your sleep, well, then that death benefit is going to go to your family. And it's going to better their lives and so forth. But if you had a need for long-term care, then obviously you can exercise your long-term care rider or critical illness rider, and then you can start withdrawing your death benefit on an annual basis to mitigate that additional cost. What if you only use 50% of it or 40% of it? Well, then upon your death, whatever remains will then go tax-free to your beneficiaries upon your death. So from a flexibility standpoint and from a velocity of money multiplier standpoint, it is a much better tool, just like the hybrid annuity that we just discussed, chassis, a little while ago. They offer you a lot more flexibility than a standalone life insurance contract would from a business perspective. Obviously, you have the ability to use life settlements. So, if you need to sell your policy in order to mitigate some additional costs, or you get to a point where you don't need that policy anymore, you can also sell it in the open market and get more than any cash values, more in most times, than you would have in there to begin with. The opportunity cost, as I said, on the hybrid annuity is also greatly reduced, because someone will always get the death benefit along those lines. So, and again, about 40% of the clients that I deal with do have a life insurance contract with some kind of a long-term care rider. So I always want to make certain that when I work with clients, that I help them protect against the risk of living too long, living with a disability, living with eroding factors, and then last but not least, the risk of dying too soon. Because if I'm able to do that for the clients, and then I have done an outstanding job, and then the clients have truly protected themselves in a way that they would have never done before with, another retirement strategist or any other advisor in the marketplace. So these are things that are critically important. Again, to emphasize, over 37 million Americans today are classified as disabled. 55 plus of those disabled are between the ages of 18 and 64. So long-term care does not mean that you have to be old. There's a large amount of Americans in the United States today that are considered disabled, and they're anywhere between the ages of 18 and 64. Now, out of the 37 million disabled Americans today, 8.8 million are currently receiving Social Security disability benefits. So that's another issue that you need to consider. There's a 21% chance of disability between the ages of 35 and 55. So for clients of mine that are either professionals or they own a business, having disability policies also very critical during their working years. And then obviously long-term care policies and or hybrid contracts, as we have discussed, will take care of the rest once they get to retirement. Interesting enough, the average group long-term care disability claim is approximately 34.6 months. So it's almost 3 years of disability. That can be a tremendous cost. I mean, forget about having to be in a nursing facility 20 years from now where the cost is going to be north of $278,000. What if it costs you an additional $100,000 a year? What impact would that have on your retirement assets, on your retirement reserves? And then even if you're able to pay for that additional cost by dipping and going more into the principal of your assets in order to mitigate that additional cost, how is that going to leave your surviving spouse? Your surviving spouse may have thought that he or she was going to have a great life, whether you were alive or not, but it could be very, very, very detrimental to them if someone in the family unit happens to suffer from a long-term care need, and that need goes for 3 years, sometimes 5 years, sometimes 7 or 10 years, depending on what it is that you have. Now, the average individual long-term care, and this is on the, I just talked to you about the group benefits of being 34.6 months, but on the individual basis, long-term care disability claims average somewhere around 31.6 or 32 months. So again, that would be close to 3 years. So now the other thing to consider is that 92% of disability, and these are disabilities that are prior to work. Those disabilities, if you're still employed, could be resolved or are usually resolved within a 5-year period. So it's important that you understand the difference between a long-term care and a traditional disability contract, because traditional disability contracts are normally used while you're working. And then upon retirement, obviously, it's important to continue to have the ability to mitigate the risk of living with a disability in the future. Final thoughts, obviously, opportunity cost and benefits are paramount issues. A traditional long-term care policy, although if you become disabled, it will do its job. But if you happen to die in your sleep, or you only had a need for long-term care for a very short period of time, then you would have an opportunity cost of the premium that you paid, plus the interest rate that you could have gotten on that premium had you invested that money somewhere else. Hybrid annuities and hybrid life insurance contracts are purchased most of the time. Life and annuity straddles for qualified clients work extremely well. So whenever I engage a client for the first time, I always try to identify all of these issues and then try to figure out, well, how do we mitigate the risk? How can we mitigate the risk in a way that if you get what you want in life, that it shouldn't cost you any money? So I think the question is, where do you go from here? When are you going to start doing your planning? The sooner that you can start doing your planning is better. So if you need to have any further discussions with me, or you have any specific questions that you may want to ask me, please feel free to reach out to me. You can call me at area code 766-1042. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com. I'll be more than happy to schedule a 30-minute or a 40-minute conference call with you and kind of figure out what are the issues and concerns that are keeping you awake at night in lieu of all the things that we have discussed today. And as always, please bear in mind that my ultimate goal is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for your time today, and I look forward to speaking to you soon. Take care. Bye-bye.